Well, the uncertainty around tariffs and the world reaction to that uncertainty is wreaking havoc on markets, including a big downward push on the U.S. dollar as some investors lose confidence in that currency. How long can it last, and what is the importance to ordinary investors? Let's bring in an expert, Brooke Thackray. He's research analyst at Global X Focus. Brooke, thanks a lot for being here. This has been a big story for investors, the rally in the Canadian dollar. A lot of people are wondering, how's the Canadian dollar up at a time when the economy is under assault from the U.S.? The reason is because it's the mirror reflection of the U.S. dollar coming down. How prolonged will this decline in the U.S. dollar be, and what are some of the takeaways for investors?
Yeah, first of all, you're absolutely right. It's not the Canadian dollar necessarily going up. It's the U.S. dollar going down relative to Canadian dollar, to the euro, to the yen. Excuse me. But we could see this go on for some time. There's a number of factors that are actually affecting this. But if you go back and take a look at what happened in the tech bubble back in the late 1990s going into the early 2000s, it might give a little bit of a roadmap to what could happen with the U.S. dollar. What was happening leading into the tech bubble is all the foreigners were buying Apple shares, Cisco, Nortel, et cetera. And what we saw at that time, this graph shows the U.S. dollar relative to world currencies, rising initially in the late 1999 into 2000 as an example. But then the market peaked. When the tech bubble broke, what we saw was those same investors sold those technology shares, took their U.S. dollars and put them back into their own currency. So you saw the U.S. dollar go down for 3 years straight like that. Well, obviously some ups and downs. That might be a little bit of the roadmap that we see right now, because if you look at the U.S. equities, there's 18% of the equities in the U.S. are held by foreign investors. And if they are selling right now, and if they're selling and taking their money out, we could see downward pressure on the U.S. dollar for a multi-year period here.
Here's a more recent view of the U.S. dollar. This one begins at the beginning of 2024 and takes us through to the big plunge of today. This is the Dixie Index, by the way, that measures the U.S. dollar in the context of that basket of international currencies from developed markets. So what is the recent trade in the U.S. dollar telling us? Well, we're seeing a lot of the uncertainty that in the markets. Basically, investors are saying, well, I don't want to be there for the U.S. dollar right now, and in U.S. investments as well. So they're saying basically, well, we've lost some confidence, and they're pulling their money out. And we're seeing this, whether it's pension funds around the world, countries around the world, central banks around the world are saying, hey, I just want to pull my money out. We're seeing some downward pressure. There's other factors at play here, whether it's the reverse of the yen carry trade, the basis trade, but a lot of it just has to do with the uncertainty, and investors saying, I'm not sure I want to be in the U.S. I'm going to pull my money out. And so what we saw was this year, in late 2024, we saw the U.S. dollar rally strongly before the election, after the election, and in early January, it started to go down as the whole tariff situation started to unfold. And if you think about it too, the U.S. has a pact with the other foreign countries. What they do is the U.S. buys their goods, let's say China, right? And they bring the goods in. China ends up with the U.S. dollars. And they say, well, now we'll take those U.S. dollars and buy your treasuries. Well, now that's being broken, because if there's high tariffs, they're not going to have as many U.S. dollars either. So it's also going to affect the treasury market. And what is the connection between the bond market sell-off we've seen recently as stocks have sold off and the currency?
Yeah, that's really unusual, because usually in a risk-off environment, you see yields go down because investors will say, hey, I want to run to the safety of the bonds. But there's been such a selling of bonds at the same time from foreigners, from hedge funds, et cetera, that we've actually seen yields go up. And that's really why Trump paused last Wednesday. It really was the bond market that forced him to do that.
Okay, you've got three picks, three suggestions in the world of ETFs, of which you're an expert. The first one is a bond ETF. It's the Global X Select Universe Bond Index ETF, ticker symbol HBB.
Yeah, so this is the Canadian Bond Index here. And, Tip Macklem did pause today as far as the rates go, but we are seeing a slowing of the economy. And in a slowing of the economy, you'd expect the Canadian interest rates to head lower, which means bonds would rise in that type of scenario. So I think this is a good place to be in this market, where there's a lot of uncertainty going forward here. Tariffs are here to stay. It's just a matter of how much. So it's going to put a weight on economic growth here. And we saw Tim Macklem come up with similar comments to that. So I think having a portion in Canadian bonds can actually help offset some of that volatility.
Okay, volatility is the key word in the next pick as well. We're in very volatile stock markets right now. You've got a low vol Canadian equity ETF as your next pick. It's the BMO Low Volatility Canadian Equity ETF, ZLB in Toronto.
Yeah, so if you take a look at what's actually been successful this year in the markets, obviously not technology, and the growth sectors have really struggled. Investors have really diverted over to low volatility in the US and in Canada as well. So examples of low volatility would be like grocery stores like Metro Inc., Empire, et cetera. And so they've actually done well relative to the market. And if we go back and take a look back in the, let's say, the great financial crisis, when we saw a lot of volatility pick up, low volatility did well in that environment again. So I think having a low volatility section also part of your portfolio also works.
Okay, and the next one follows that theme, perhaps. You'll tell us this is a defensive style ETF. It focuses on the utilities. It's the utilities sector, the utilities select sector SPDR Fund, XLU. So this would be a basket of U.S. utilities, correct?
U.S. utilities, which is different. Now, the caveat here is this is in U.S. dollars. So investors should know that. When you're investing into U.S. securities, you're making two decisions. One's about the currency,
right,
and one's about the equity itself. Right. I'm looking at this from a nominal perspective and saying, what do I expect from as far as the utility sector goes? And I expect utilities in Canada to also do well. And this is a defensive play in that. So if there is a portion of U.S. stocks that you have, this is probably not a bad place to be in that portion. So you're a bit more defensive as well.
Okay. On the subject of currencies and ETFs, purchasers of Canadian ETFs very often have a choice between a hedged version and a non-hedged version. It's hedging in or out the Canadian dollar, U.S. dollar exchange rate. How should they be thinking about that choice right now?
Yeah, so that's the two choices as far as that goes. If you believe the U.S. dollar is going to continue to go down because of a number of factors, we discussed that a little bit here, the better choice would be to buy the hedged version. So you're not being exposed to the U.S. dollar currency. So that's being hedged out. So that would be the preferable if you believe the U.S. dollar is going down.
Brooke Thackray, thanks a great deal for stopping by.
Oh, thank you.
Brooke Thackray is research analyst at Global X Focus.